Hello everyone, this is Rahul Singh from Tata Mutual Fund. I'm going to talk about the budget and the proposals and how it is good for the economy and the markets. Overall, the budget has provided for higher government spend without increase in personal and corporate tax, and I think that's the key message. And in addition, the government has talked about a lot of reform measures, including privatization, which is going to add to revenues over a period of time. I think what this budget will do is to support economic recovery, create earning upgrades for the corporates in next fiscal year and beyond, and thus support India's so-called premium valuations. Though there is a likelihood of slightly higher interest rates as a result and what it could do to valuations for equities, I think it can get offset a bit by the superior earnings momentum, especially if the budget is successful in reviving the investment cycle beyond the consumption cycle, which is already revived. I think no changes in the capital gain structure was a big sentiment positive for the markets. Overall, I think looking back, I think the cyclical recovery in earnings, which is underway in fiscal 22, I think will get a boost in the proposals from the proposal of this budget and the way it is trying to revive the investment cycle. For funding of projects, significant institutional setup has been planned to execute and monitor the monetization of assets owned by PSUs or government undertaking. This is in addition to privatization. There are three key reforms for the financial markets: single securities market code, improving liquidity for the bond markets in times of stress, and increasing the FDI limit in insurance from 49% to 74%. As I said, I think privatization, while it is not really a surprise, I think what really was a positive surprise was that two PSU banks and one general insurance company has also been added to the list, which is a fairly bold move. Of course, a lot depends on execution, but the intent is very, very clear. Lastly, the ARC, which has been set up to take care of the stressed assets and buy the stressed assets from specifically the PSU banks, though we think has come out 2-3 years too late, I think it will help in getting stress out of the PSU banks and get some PSU banks ready for privatization. So all in all, it appears to be a very well thought out, coordinated package. Not trying to tax too much, but still trying to spend by borrowing, but spending wisely through capital expenditure. The budget's focus in terms of various sectors is clearly positive for the cyclical sectors, which include industrials, capital goods, metals and mining, and banking. A broad-based economic recovery is also going to lead to a slightly better potential upside in the mid and small caps. Whenever there is a broader economic recovery, we have seen that the fruits of that are enjoyed not only by the large caps, but more prominently by the mid and small caps and the smaller companies. And I think that is the other message which I wanted to leave. And also in our portfolios, we have been gradually increasing our portion of that. I think infrastructure and manufacturing revival will be key themes for 2021. Given the thrust to this sector in the budget, banking is the play on economy, so obviously it's going to do well. So we are going to see more cyclical sectors, more domestic cyclical sectors doing better than some of the sectors which are more leveraged to the global economy or to consumption. So overall, just to summarize, the fact that there were no changes in taxes coupled with the boost for growth, which is very, very clear and the intent is very clear, makes it a double joy for the equity markets. Thank you.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.